Hello, my name is James Pavlicek and welcome to my video walkthrough of my Python portfolio backtest project. So this video will provide a deep dive into investment simulations using Python and a web application I built to visualize it. So starting off with how I got the idea for this project. So the inspiration for this project arose when I was sitting down with my dad during the summer and he wanted me to look over his investment portfolios and his retirement account to see how it was doing. So after looking over his account, I noticed that he was being charged a lot of management fees by the asset management firm that he was utilizing. They were charging him the let's drink coffee while you look at your portfolio fee, the let's sit down and do nothing fee, the thank you for being a member for 10 years fee. So a lot of unnecessary fees for really nothing to happen. Another thing that I noticed was he was getting a much lower rate of return in comparison to other stock benchmarks. So it was below the Dow, it was below the NASDAQ, below the S&P 500. And I was like, why are you paying these fees to these people if the return that you're getting is not comparable to at least the stock market? Why are we doing this? So that kind of cultivated the inspiration for this project. I was also curious, like, how is this impacting like other families as well? So how is this impacting my dad, and more so if it's impacting my dad and my family, it's going to be impacting other people out there as well. So to jump right into how I broke down this project, I wanted to break it down into 3 simple steps, kind of 3 background categories that I wanted to plan out when building the portfolio. So I'm going to jump into that right now. I'm going to share my screen. So this is going to be my Medium article. So if you guys want to follow along with what I'm saying, or if you want to save this article to read later, the link is going to be in the description. So for, like I said earlier, planning the 3 different categories that I wanted to kind of break down and identify before I got it started with the project. The first of which is, what financial theories am I going to use on this project and why? So the first one that came across was the modern portfolio theory. This was a theory developed by Nobel Prize winner Harry Markowitz. One cool thing about his theory is it encompasses the efficient frontier, which can be displayed here in this image. So all of these green dots are randomly simulated portfolios, and the x-axis is your risk, your volatility measured in standard deviation. On your y-axis, it's going to be your return. So as we can see, for example, if we compare 2 different portfolios, let's say this portfolio and this portfolio below it. The portfolio below it wouldn't make much sense comparing to the one above it, because you're getting the same standard deviation, same risk, same volatility of your investment, but the portfolio up here, you're getting a higher expected return. So there wouldn't be much of a reason to have this portfolio down here if you're experiencing the same risk but not experiencing the same return. So the blue line here is the outskirts, the outsets of the data, and this is going to be your most efficient portfolio. So it's going to give you your best risk to return ratio, also known as your Sharpe ratio. So the next thing that I was using for this project is the portfolio standard deviation formula. So what this does, if you have 2 assets that are not perfectly correlated with each other, there is a diversification benefit, which is measured by this formula here. So the example that this formula is using is 2 assets. The first one has a return of 10%, standard deviation of 10%. The second asset B, has a return of 20% and a standard deviation of 20% as well. So your return is going to be your average of the weighted returns. So it's going to be 15%. And your standard deviation is not going to be the average of the weighted standard deviations. It's going to be calculated by this formula here. So this is assuming a 0.5 correlation and a 50-50 split in the portfolio. And you can see that the portfolio standard deviation is 13.22% instead of 15%. So by combining 2 assets together, you're actually able to lower your standard deviation since they're not perfectly correlated. So this is kind of a visual representation of what's happening when you're combining those 2 assets. So asset 1 and asset 2, they're kind of on different trajectories, but when you combine them into a 50-50 portfolio, or a portfolio of any allocation or the most optimized allocation, you can create more of a straight line that doesn't have as much upwards and downwards volatility. And the next thing that I was looking into is the importance of an easy to use interface. So when making this and understanding that other people might be using this as well, I wanted to make sure that the tool was as easy to use as possible, because already in the financial space there's a lot of confusing things, a lot of big barriers that kind of inhibit most people from getting in. So I wanted to make it as user-friendly as possible. So what I did was I only have 4 to 6 different specified variables that you have to enter. So we're going to cover that a little bit later when I run through the program. And this is a big difference compared to other financial tools out there. The financial tool that I used before this is called Portfolio Visualizer. And you have to enter in 29 different variables if you want a 8-fund portfolio. For mine, you only need 4 to 6. So that was another key importance, was making this as easy to use as possible. And the next thing was, what did I want the user to take away from this experience? So the first thing I wanted the user to take away was an overall positive experience, and just making sure that they felt more confident about what they were doing and had a better understanding of what their money can do for them. And then the next thing I wanted to do was an actual physical handout of what's going to happen. So when the program is completed running, there is a stock shopping list that is outputted onto a PDF document, and it kind of breaks down exactly what's happening. So as we can see here, this is a stock shopping list that was generated based off the investment details of age of 25, risk of 6 out of 10, duration of the investment is 5 years, and initial investment of $100,000 with recurring monthly investments of $1,000. So you can see that there is the amounts that you have for the initial investment, as well as the shares and the tickers that you're going to be investing in addition to the repurchase list of what you're going to do every month. And from there, we'll come back to that shortly and run through the application. Real quick, I'm going to go through the development. So the majority of this project, the data set was Y-Finance, Yahoo Finance, a Python package, and all of the coding was done through Python. So if you want to see all of the code, there's going to be a GitHub link in the description as well. In the article, I have some snippets of what the code is doing. For example, in this snippet, this is where you're generating the random portfolios and calculating the standard deviation volatility. And in this snippet, it goes over your risk score and finding the highest standard deviation, or the highest return for the specified standard deviation range. So what this formula is doing is, if say you have a risk score of 74, it gives a 2% variance. So it goes from the 72nd to the 76th percentile, and that's shown here. And it'll get the portfolio with the highest return. So that's what that code's doing. And now with the code done, the focus shift to setting up the user interface, which I'll go over now. So this is the tool. As you can see, there's the 4 user specified inputs. If you add a recurring investment, that adds 2 more. This is hosted on Streamlit, which is a very helpful tool for Python coders to build web-facing applications. So let's say we can run a sample portfolio. Say your age is 40 and you have a risk of 8 and you want a duration of 20 years of your investment. Say we have $200,000 and a recurring investment of 1,000 every month. So we'll click calculate results. It'll say information received, ideal portfolio will be displayed shortly. And now there is 10,000 portfolios that are being simulated behind the scenes. Their standard deviations are being calculated, their returns are being calculated, and it's going to output the best portfolio for the specified age and risk and duration of the investment. And while this is running, I'm going to show you that up here in the top right, you can click this GitHub icon, and it'll bring you to all of the code that is running this software. So if you're interested in coding like me, feel free to dive into the GitHub and get a better understanding of what's going on. So the results, so these are the outputs of what's happening. So the first thing that you're going to see is a portfolio outlook. This is going to be a graph. It's going to show you your portfolio compared to a total stock market benchmark and a benchmark of 75% stock to 25% bonds. So you can see that it's graphed out just like that. And if you want a further explanation of what's going on, we can see here the portfolio comparison gives you the mathematical numbers, the stats of what's happening. So it tells you the ending value of the portfolio, the return of the portfolio, the risk of the portfolio, the Sharpe ratio, which is a measure comparing your return and your risk, and in addition the risk-free rate, and in addition the minimum and maximum of the portfolio as well. The last thing, or not the last thing, but the next thing that this will output is your portfolio allocation. So it'll tell you how your portfolio is split up. So this portfolio is split up 36% into US large caps, 26% into US mid caps, and then all of everything else specified there. Then we get into some fun advanced stats. So this is your efficient frontier. It also has the capital market line graphed on it as well. So that's going to be your risk-free rate of return here, which is an average of 3% over the last couple years. And you can see your portfolio here, the nice golden star, compared to the total stock market here. So you can see that it's a similar standard deviation, similar volatility, similar risk, and you're getting a increase of about 1 basis point in return. And then this is your stock to bond portfolio as well. So you can see, how does my portfolio compare against the other portfolio benchmarks and then the other generated portfolios? The next cool thing that is outputted is a correlation matrix. So this tells you how your stocks are correlated to each other. So with the portfolio standard deviation that we're talking about earlier, the further that these are correlated from each other, and the scale is from -1 to 1, the further that they're correlated from each other, the more diversification benefit you have from combining them within your portfolio. So we can see here VTSMX is going to be your total stock market portfolio, and VIVAX is going to be your, I believe, value large cap stocks, and they have a 0.96 correlation with each other out of a -1 to 1 scale. More in comparison, you can see that your short-term treasury bonds is going to be a -0.21. So that's going to be two assets that are differently correlated and perform different at the same time, and it's a benefit to have those in your portfolio because you get the diversification benefit. So the next thing that we have is your portfolio report. So there is a neat, easy to use portfolio that is outputted as a PDF. And we can see here your portfolio backtest report. It has a chart of your performance in addition to the stats of what's happening. You have a pie chart of your portfolio allocation. Additionally, you have a stock shopping list, which is your actionable steps of what you can do from this point on. So you can go through and say, okay, I have, I believe for this one, it was $200,000. You also have your inputs at the bottom. You can say, okay, cool. I have, out of my $200,000, I'm going to go get 149 shares of VTI, 134 shares of VTV, 205 shares of QQQ, and so on. Also has a stock repurchase list at the bottom. So you can say, okay, every month, I know that I have to go out and get XYZ of every so amount of every so ticker. So swinging it back to me now, this is a project that I really think that all of y'all should take a look at, and let me know what you guys think about it. The link's going to be in the description for you guys to view it. Let me know if there's anything that you think that I can improve on, anything that you feel that is not needed, not necessary, or too confusing. I'm really open to input. You guys can let me know via LinkedIn, which will be in the description below, or in the YouTube comments. Anywhere is appreciated. So also I have to let you guys know that I am not a financial advisor. So anything in this video that is covered is not financial advice. So the report that was shown, The application, all of the information I covered at the beginning is not financial advice, so do not act upon it. This is purely educational for me to explain what I learned in class and what I learned on the side to better myself in my career. So I want to kind of hop into the conclusion of this project. So this project is a great tool that combines the modern portfolio theory in addition to the standard deviation return of a portfolio in junction with randomly simulating portfolios. And I feel that it's been a pretty fun project and very insightful and helpful for me and my investment decisions, and as well as my family's investment decisions. And I want to thank all of y'all for coming through with me on this journey, watching this video, reading the article, using the tool. I want to thank you for doing that with me. So thank you for all your time today, and I look forward to seeing you in the near future.